Welcome to Iron Financial. This is the only place on the street where we forge stronger portfolios by putting company earnings through a real trial by fire. I'm your lead analyst. Today, we are putting on our hard hats and digging deep into an absolute monster of a quarter from a name you definitely thought you knew. Levi Strauss. That's right, the denim icon just dropped a report that sent the stock absolutely rocketing after hours. Our job here is simple. We are going to stress test this structure. We're going to kick the tires, we're going to inspect the foundation, and we're going to figure out if this thing is built solid or if it's just a pretty facade waiting to crumble. All right, let's get to work.
And I'm your market skeptic. You know, everyone loves a good comeback story. An old-school, 150-year-old brand suddenly starts posting numbers that make even the slickest growth investors sit up and pay attention. But my job is to cut right through that hype. A company this old doesn't just reinvent itself on a dime. The market is an absolute graveyard of legacy brands that showed a little flicker of life right before they fizzled out for good. So the question we really have to answer today, the big one, is this. Are we looking at a genuine, structurally sound turnaround, or is this just a dead cat bounce before the inevitable collapse? That's what this whole stress test is really about.
Exactly right. And to figure that out, we've got a detailed blueprint for our entire inspection today. First up, we're going to look at the new design, those shiny headline numbers that got everybody talking. Then, we are going straight down into the engine room to inspect their direct-to-consumer strategy. After that, we'll check the global framework. Is this strength holding up all around the world? From there, we go to the very bedrock of the company, fortifying the financial foundation by digging into the balance sheet. Then, we'll take a hard look at the reinforcements they're giving back to shareholders, the capital returns. And finally, we deliver the verdict. Is this company actually built to last? Okay, let's get into it.
So, we're starting our inspection from the outside. You know, before we start looking for any cracks, let's just step back and admire the finish. And believe me, the finish on this Q1 report was absolutely gleaming. The top-line numbers, they didn't just meet Wall Street's expectations, they shattered them. They showed a level of raw strength that caught a whole lot of seasoned analysts completely flat-footed. I mean, this is the kind of performance that just demands you take a much, much closer look.
Okay, let's start with the big one. $1.74 billion. That's the reported revenue for just one quarter. Now that's a 14% jump year over year. You have to understand, for a company of this size, this maturity, and in an economy where we're told consumers are pulling back, posting double-digit revenue growth like that is some serious heavy lifting. This isn't some little startup we're talking about. This is a global titan, and it's showing signs of powerful, real acceleration. That number all by itself is the first big signal that something truly fundamental has shifted deep inside their operations.
And look, revenue is just noise if you don't have profit. The bottom line was just as solid. Adjusted earnings per share, or EPS, came in at a strong 42 cents. Now, what this tells us is that they aren't just chasing sales no matter the cost. No, they are converting that incredible top-line growth into actual, tangible profit for their shareholders. And they're doing it while navigating some serious headwinds, like higher tariffs and spending more on advertising. This potent combination of strong revenue and disciplined profitability, well, that's the bedrock of any solid investment case you're ever going to find.
Okay, hold on a minute. Big numbers are fine, but context is king. Are these numbers actually all that impressive, or are they just, big? Right now, it feels like you're just throwing a pile of raw materials at me without the architectural plans. How do we really know the structure is as sound as you say it is? That is a fair challenge, and it's exactly where the raw materials meet those architectural plans. So let's look at the blueprints from Wall Street. Their plan called for about $1.68 billion in revenue. Levi's didn't just meet that plan, they built right past it by a cool $60 million. And on earnings, the street was looking for maybe 38 cents a share. They came in and delivered 42. See, this isn't just about hitting a target, this is about decisively and powerfully clearing it. It proves that their internal strategy is executing at a level that is surprising even the people whose entire job is to watch it this closely. That is what I call real structural strength.
All right, so the exterior looks solid. Now it's time to go deeper. We're moving from the curb appeal to the core mechanics of this thing. The single biggest driver of this whole transformation, the engine that's powering this entire structure, is the company's major pivot to a direct-to-consumer or DTC model. And let me be clear, this isn't just a fresh coat of paint. This is a complete and total rewiring of their business from the ground up. So let's get in there and inspect the engine room. What you're looking at on this slide, it represents a monumental tipping point. For the first time in the company's long history, direct-to-consumer sales now make up 52% of their total net revenues. This is a massive, strategic earthquake. For more than a century, Levi's was a wholesale company.
They sold their jeans to department stores, to other retailers. Now the majority of their business is them selling their product directly to you and me. The implications here are just huge. They control the entire brand experience, they get to keep the full retail margin, and, maybe most importantly, they get priceless data on exactly what their customers are buying. This is not just another sales channel, it's the new foundation of the entire company.
Okay, so DTC is the shiny new engine, I get it. But you know, a powerful new engine can rip an old chassis clean apart. So what I want to know is if this is all just a shell game. Are they just robbing their wholesale partners blind to pay for these flashy DTC numbers? Because look, if they're burning the bridges with the very retailers who built their brand for 100 years, just so they can chase a few extra points of margin, well, that's not a steel framework. That's a structural weakness that's just waiting to buckle under the slightest bit of pressure.
And that's the exact stress test we need to run here. And the data gives us a very clear, definitive answer. Absolutely not. This is not a zero-sum game. Just look at the strength across the board here. DTC net revenue is up a massive 16% on a reported basis. Inside of that, their own e-commerce is up an explosive 21%. But here's the kicker. Look at wholesale. It is also up a very, very healthy 12%. This is not cannibalization. This is broad-based, powerful expansion. They're not just reallocating the floor space in the building, they are literally adding new floors. This is a sign of true, deep structural integrity. That broad-based channel growth is a critical point, no doubt about it. But a strong foundation in one single location doesn't mean the whole building is secure. So now we need to zoom out and inspect this thing as a global construction project. Is the strength we're seeing just some North American thing, or have they built a structure that can stand strong on a worldwide stage? Let's check the international specs on this.
And the global footprint is rock solid. The Americas, which is their most mature market, posted a very respectable 9% reported growth year over year. Not bad. Asia came in really strong at 13%. But the real headline here, the main steel beam that's supporting this whole global expansion, is Europe. A 24% increase in reported revenue. I mean, that is an absolute blowout number. It shows that their brand and their new strategy are resonating powerfully across the Atlantic. This isn't a localized success story, it's a global phenomenon. But let's put a little pressure on those numbers. I mean, Europe's 24% growth is impressive, I'll give you that. But it also makes the Americas' 9% look, frankly, a little sluggish by comparison. That's their home turf. It's their biggest market. Is 9% really something to write home about when the rest of the world is growing so much faster? To me, it could be a sign that the domestic foundation is starting to show its age a bit, while all the newer overseas additions are providing all the support. That's a potential imbalance we really need to keep an eye on.
That is a valid point, and it's something to monitor for sure. But look, a building can have a beautiful design and an impressive size, but if the foundation is made of sand, it's all completely worthless. Strong sales and global growth mean nothing if the balance sheet is crumbling underneath. So for this next phase of our stress test, we are heading down to the bedrock. We need to check the company's financial foundation. We're talking cash, debt, inventory. This is where we find out if the company is truly built to withstand a storm.
And from what I'm seeing, the foundation looks absolutely fortified. First off, they're sitting on $717 million in cash and cash equivalents. Their total liquidity is approximately $1.6 billion. That is a significant financial cushion. It gives them flexibility, it gives them durability, and it gives them the resources to invest in growth or to easily weather any economic downturns that might come. Long-term debt is just a hair over $1 billion, which is very, very manageable for a company of this size and this level of profitability. Okay, the liquidity looks good, I'll grant you that, but my eye is drawn to that inventory number. Inventory grew 4% year over year. Now look, 4% isn't a five-alarm fire, I get it. But in the world of retail, rising inventory can be the very first sign of trouble. It can signal that demand isn't quite as strong as the headline sales numbers suggest, and it often leads to future margin pressure from having to put everything on sale. So is this 4% rise a sign of disciplined management, or is it the first small crack appearing in the foundation?
You know, a 4% inventory increase against 14% revenue growth is an incredible display of discipline. What that means is they're selling through product almost as fast as they can make it, which leads to less discounting and much healthier margins down the line. And that speaks directly to the point you just hit on. Let's look at this quote from Harmit Singh, the outgoing Chief Financial and Growth Officer. He says, and I quote, "Our strategic transformation is translating into higher returns and more profitable growth." Singh has been a key architect of this entire turnaround, from the 2019 IPO all the way to the DTC pivot we've been talking about. He's one of the master builders here, and his words carry a lot of weight.
Whoa, hang on a second. Did you just say outgoing CFO? The man you just called a key architect and a master builder is retiring? So the company announces this unbelievable blockbuster quarter, and in the very same breath, they mention the guy running the numbers is packing his bags and heading for the exit. That is not a small detail. That is a potential seismic event. You can talk all you want about a solid foundation, but when the chief engineer suddenly decides to walk off the project, I have to ask, does he know about a crack in the foundation that we can't see yet? To me, this is the single biggest red flag in this entire report.
That is the million-dollar question, isn't it? And it's a risk we absolutely cannot ignore. But while we're busy looking for cracks, management is actively reinforcing the structure with cold, hard cash. They are sending one of the most powerful signals of confidence a company possibly can. Let's look at the shareholder payout, because while leadership changes are definitely concerning, these actions are screaming confidence from the entire executive team, not just one person.
$214 million. That is how much cash Levi's returned to its shareholders in the first quarter alone. That's through dividends and very aggressive share buybacks. Think about it. A company that sees cracks in its own foundation. They don't just hand out over $200 million. No, they hoard cash, they shore up their defenses for a rainy day. This is not the action of a nervous management team. This is the action of a team that is so unbelievably confident in their future cash flow and financial stability that they are willing to put their money where their mouth is in a huge, huge way.
Okay, there you go again with the big numbers. Is that $214 million a lot for them, or is it just business as usual? You've got to put it in context for me. Happy to provide it. That's the most important question because, again, context is everything. That $214 million figure, it represents a 163% increase in capital return to shareholders compared to the exact same quarter last year. 163%. This is not some small scheduled bump in the dividend. This is a deliberate, aggressive acceleration of their entire capital return program. They launched a $200 million accelerated share repurchase. This is management looking at their own stock price, even after the run-up, and basically shouting, "This is a bargain." It's a statement that they believe the single best investment they can make is in their own shares. That's the kind of move that demonstrates absolute, unshakable conviction in their future.
All right, we've inspected the exterior, we've stress-tested the engine room, we have checked the global framework and the financial foundation. We've seen the impressive new construction, and we've also identified some potential stress points. So it is time to bring all the evidence together and deliver the final verdict from this stress test. Is Levi's Q1 performance a true sign that this company is finally built to last?
Okay, so here's the bottom line. The structural strengths are just undeniable. You have DTC now making up the majority of the business. That's a higher margin, more resilient model. You have broad-based growth across every single channel and every major global region. You've got a fortified balance sheet with plenty of liquidity, and you have management showing extreme confidence through those massive shareholder returns. The bull case is solid as a rock. But those cracks are real, and you can't just plaster over them and pretend they're not there. First, margins did decline slightly year over year because of tariffs and advertising. That pressure isn't just going to disappear. Second, the Americas' growth, while it's positive, is lagging. That needs to be watched like a hawk. And most importantly, the key architect of the company's finances is leaving. You cannot understate the risk that a leadership transition like this brings. These aren't just cosmetic issues. They are potential fault lines that could widen under pressure. The structure is strong today, sure, but what about tomorrow?
And that is the final crucial piece of evidence. Management's answer to that question of what about tomorrow is sitting right here. They raised their full-year guidance across the board. They are now telling the world they expect reported revenue growth of up to 6.5%. They see their adjusted EBIT margin expanding to around 12%. And they've raised their adjusted EPS guidance to a range of $1.42 to $1.48. This is their forward-looking statement on the durability of their business. They are not just patching holes here. They are actively raising the roof on their own expectations for the rest of the year. This is the ultimate rebuttal to any concerns about the foundation. So, our stress test is complete, and Levi's has passed. The company has successfully pulled off a very difficult strategic transformation, evolving from a wholesale heritage brand into a dynamic, DTC-first global powerhouse. The evidence, from the huge revenue beats and global growth to the balance sheet strength and the raised guidance, it all points to a structure that is sound and truly built for the future. The potential cracks, like the CFO transition and those margin pressures, are valid risks to keep monitoring, but they are absolutely outweighed by the overwhelming structural strengths. Levi's has proven its new framework is strong. The question for investors is no longer if it's built to last. The question now is, how high can they build? And that's the takeaway. Thanks for joining us here at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.